This video is for Class 35 of Engineering Economy on Friday, April 6, 2018. Let's take a look at a couple of announcements here before we get into the material. First of all, homework 13, which is related to inflation. That assignment's due on Wednesday, April 11th, so please be sure to upload your assignment to MU Online before class on that day. Also, as a reminder, the project is due on Monday, April 16th. And so if you have questions about the project, please feel free to stop by during my office hours. I'd be happy to talk to you about that. Today's presentation is going to be a continuation of the previous lecture where we were talking about inflation. This time we're going to look at an in-class exercise that has to do with future worths, future amounts, and capital recovery, which of course is the amount of money that you have to be taking in to cover the purchase price versus the salvage value of a piece of equipment. So as a reminder, this recorded lecture was the bulk of it recorded in a previous semester, so there may be some incidental references to dates or times that doesn't quite match up, but the material itself is the same, and if you have any questions, please let me know by email.
So this is what we saw last time in class, where we were looking at the relationship between present value and future value when we're accounting for inflation and the real interest rate. Remember that the real interest rate I is related to an increase in purchasing power. And we talked about how if you put money into the bank under certain circumstances, you actually can be losing purchasing power, and that's if the bank's market interest rate is lower than the inflation rate, like is for the most part nowadays the situation. So we've seen this before. What we're going to be doing today is, rather than calculating present values, just applying the same thing, the same process to future values. You know that we've done some of our analyses and comparison on the basis of what has the highest beneficial present value, but you can also sometimes find yourself in situations where you have to compound amounts into the future when comparing alternatives. And one situation where that's the case is where you're selling a business and you're trying to figure out what would be a reasonable sales price for a business some years in the future, or it can be related to a multi-year project that has costs accumulating through many years, and it's not just a single one-time investment in year zero that accounts for the costs. All right. So the interest rate that banks are paying is the market interest rate. That's what they quote. The I sub f in this formula is the market interest rate, sometimes also called the inflation-adjusted interest rate. Well, it's affected by inflation, but not directly. In situations where the inflation becomes higher, like right now, inflation is relatively low. There are situations like we saw the graph in class last time where in the early 1980s, inflation was over 10%. Well, savings accounts back then paid a lot more than they do now. And so market interest rate is indirectly affected by inflation. Now, the market rate that you receive may be more than inflation, which is F, and in a situation like that, that would lead to a positive real interest rate, I, meaning that your purchasing power is going to go up over time. Unfortunately, right now we're in the situation where the market interest rate is less than inflation, which means you have a negative real interest rate and purchasing power is decreasing over time. We're going to look at such an example today where you actually, in this formula, are going to be solving for I, and the I that you'll calculate will have to be negative in order to get the market interest rate equal to the right-hand side of the expression, which also accounts for inflation. And as I indicated in class last time, banks prefer not to acknowledge the idea of real interest rate because people would be dissatisfied if they realized that they're losing purchasing power because of the reduction in the reduction in the value of their money due to inflation being greater than the market interest rate that's being paid. So there's two different kinds of money. There's money now and there's money in the future. And what we've been learning from the very beginning of the course is that money in the future doesn't have as much value as the money today. And so when we're doing calculations and trying to account for inflation, one of the approaches for this is to take a cash flow diagram and make changes by discounting everything using the inflation rate, and then do the remainder of your calculations using I, the real interest rate. So let's say, for example, that you know your company wants to make a 10% real return. What you would do is you'd take all of your cost and revenue projections that are on the cash flow diagram and convert them into constant value dollars, meaning convert them into the amounts that are equivalent for today's value of money. So you do one step where you're discounting things at F, and then the secondary calculations you'd be solving at the real interest rate you hope to achieve. Of course, doing it in two steps can be a bit of a burden, and so then the other approach is just to combine these two interest rates together, combine the inflation rate and the interest rate I that your company hopes to achieve, and then you leave the cash flow diagrams in their original inflated dollars, meaning the amounts that are expected in the future, and then do all your discounting and calculations using the market interest rate, I sub f. And so when we've done cash flow diagrams in the past, just for sake of simplicity, often what we would do is have an annual series where the amounts were the same over time. You know, for instance, we'd be making some investment, and then there would be a series of revenues over time that were equal. Now, this approach is kind of unrealistic because if you're operating a business, most likely you're going to have increases in the amounts that you charge your customers, regardless of what it is. Over time, prices are going up. And so what this means, in reference to the slide here, is that you would have to prepare a cash flow diagram with inflated dollars. So you'd expect, instead of an annual series of constant amounts, you'd want each year to be the actual inflated amount that you expect to recuperate during those years. And then when you're solving for I, you'd use the market interest rate I sub f. This first point is saying, let's assume that you've done the calculations to turn everything into constant value dollars. And so if you have an annual series where all of the revenues are the same amount, that would be the outcome of turning everything into constant value dollars. You're saying, I've already discounted everything at the inflation rate F, and then as the secondary step, you'd find the present value of those revenues at I. So I know that's a bit confusing before you apply it to some calculations, but the book has a pretty useful table that summarizes what to do in certain situations. And so what you can do with this is you can figure out whether you're trying to find the actual amount that's in an account that's accumulating a balance over time. So if you're depositing money into a bank account and you want to find out the amount that's going to be on the statement after some time, then the calculation here, what it's showing is that there's two different interest rates. There's the inflation rate F, and then I sub f, which is the amount the bank is actually paying. And so if you use that 10%, which is the amount that the bank is actually paying, that's the interest rate that you'd use to find the actual number of dollars in the future. But now, here in case 2, what it's saying is account for the fact that you're going to have a 4% increase in costs over time. And so your purchasing power isn't going to be as big as it might seem by applying case 1. And so they're dividing by 1.04 to the 7th power in this example because there are 7 years of compounding. And so you're going to find in the numerator here the number of dollars, but then dividing by this factor in the denominator, it'll tell you the amount of dollars in terms of what they're worth now. And so you're doing two things. You're compounding the amount into the future, but then you're discounting at the inflation rate. So the alternate approach to that, see, this is doing it in 2 steps, just like it was saying here in the first way of doing it is to have 2 steps, one with the inflation rate and one with the interest rate I. So here, in the second approach, what they're doing is using the real interest rate I, which was calculated based on the I sub f and the inflation rate. And so you just calculate the purchasing power, the constant value amount of dollars in the future with that approach. Case 3 is where you're trying to find out how much would you have to put into the bank now for a certain amount of purchasing power in the future. And you'll notice that they're using the 4% interest rate for that because that is the rate of inflation. And so if you want to know how much $1,000, if you want to know the purchasing power of this $1,000 you've got today in the future, how many dollars you'd need, then you apply the 4% interest rate. And the final case, case 4, that's illustrated in the table, is when you want to have the purchasing power and earn a return. And so in this case, you're using the market interest rate I sub f. So today's in-class exercise kind of takes you through some of those different cases. And one of the things that you're going to have to do on the second part of the in-class exercise is find out a capital recovery amount. So if you're accounting for both the amount of return you want to make and the inflation, you're going to have to know how much should you charge people to justify an original investment in year 0. And remember, the definition of capital recovery is it's the annual revenue you need to balance out the initial purchase price and also the salvage value at the end. And so if you sell an item at the end of its useful life for scrap or on the secondary market, the difference between the initial purchase price and the salvage value, which you'll discount to year 0, is balanced out by some annual amount. And so this factor that's shown on the screen here is the factor you can calculate for any interest rate. Of course, we have the tables for certain fixed interest rates, but the reason why it's helpful to have this equation is that oftentimes you're going to be calculating with some odd number for I sub f. When you account for the real interest rate that you want to make and the inflation rate that's out there, most likely the I sub f you end up with isn't going to be one of the values that's in a factor table. And so you have to use the factor formula instead. And so this formula will give you the ratio of the annual amount to the present value. So if you had some original purchase amount that you paid in year 0, you'd use that as the P. And so you'd multiply this factor by P to find out how much annual revenue is needed for a certain number of years. And then the interest rate that you'd apply here is the I sub f. Okay, so this is the in-class exercise. In 2 parts, we're going to do a future worth set of problems and a capital recovery set of problems. Does everybody get a copy of the paper? Okay, so let's say that there's a money market account that's offering 1.25%. That's the market rate. And we have an inflation rate of 3%. And we're depositing $110,000 at the present and 8 years, n equals 8. So what we want to find out as the first thing is just the actual amount of money that's in the account based on the market interest rate. In part B, the present value of that, the real interest rate, and then the amount that we'd have to get from the bank if we wanted a real interest rate of 1.25 instead of just the market interest rate being 1.25. Let me remind you of some variable definitions. I sub f is the market interest rate and I is the real interest rate. And so on part C, you're solving for I, which means you're solving for this one, I. And you're given I sub f, this 1.25 is the I sub f. The answers to the first three are on the screen there if you want to double check what you're doing. Part B kind of shows the effect of a negative real interest rate. It's saying you put $110,000 in the bank, and after 8 years, the amount that you have, this $121,000, it is the amount that today is equivalent to $95,908. So it's showing you that your purchasing power is decreasing. You know, today, the amount of stuff that you can buy for $110,000, you're not going to be able to buy that same amount of stuff in the future because inflation is bigger than the market interest rate that's being earned. And then if you want to find out how much you would have to make from the bank to have a real rate of return of 1.25% instead of just the market rate of return being 1.25%, that's when you apply this formula and solve for I sub f. So in part C, I sub f was given. That was the amount that the bank is paying that's fixed at 1.25%. But then in part D, you're saying, well, I know I, and I'm given inflation rate, so solving for I sub f. The solution that I'm showing on the screen right now, it says AED is the currency, but all of the calculations are the same if you do it as AED or as dollars. So don't be thrown off by that.